Tonight on Market Call, we have David Burrows, President and Chief Investment Strategist at Barometer Capital, and he's taking your questions on North American large caps. Hello and welcome to Market Call tonight. I'm Mark Bunting. Thanks a lot for joining us. A special welcome to our listeners on Sirius XM satellite radio. You can now listen to Market Call tonight 5 days a week at the usual time on the Canada Talks channel on Sirius XM. That's channel 167 on the dial. Here are the ways to reach us. If you have a question for David, you've got the email address, marketcall@bnn.ca. Call toll free if you like, 1-855-326-6266. And our Twitter handle is @MarketCall. Hello, sir.
Great to be here.
Are you concerned about a slowdown in China and all the debt that's piled up there with the regional governments?
So we are quite bullish on developed markets equities this year. But if there's something that we have to watch, it is what's going on in Asia and specifically in China. I think that the biggest risk to the current good equity markets is some kind of credit problem blowing up. So I'm not sure that we're there. Having said that, across our firm, we have virtually no developing market exposure. And sort of as a corollary to that, we have very little by way of commodities exposure because clearly, there is a slowdown going on. Credit is somewhat constrained. But at this point, I think that that's all that you have to look at. I don't think it's enough to have an impact in other parts of the world at this point.
Another story today was Argentina. The peso plunging about 15%. You were around managing money in 2001 when it needed to be bailed out. A lot of people say it's kind of heading in that direction again. Can that kind of thing be contained, or could that have a ripple effect?
I think pretty clearly when you look at a lot of the South American countries and what's been going on in their equity markets, there's been problems telegraphed for some time. A lot of the currencies are quite weak. A lot of pain when commodity prices are weak. So I think that there are some issues down there that are going to need to be addressed. We've been short Chile, and we're short Brazil, and we've been short Colombia. So I think that there are issues in some of these developing markets that we have to be aware of and be careful of. But those same things actually are somewhat helpful to developed markets because disinflationary pressure coming from weaker commodity prices, good for the consumer in North America, and certainly is helping margins overall for big businesses.
How do you short those countries? Through ETFs?
Just using ETFs.
ETFs, okay. Now, our viewers know that you hate dead money. You want your money to be working in sectors and stocks that are working. What's working now?
This is a great market if you're an active investor. This is the kind of market where by picking your spots, you can really add value. Because for the last year, correlations, or the degree to which stocks behave the same, have been coming down, meaning there's some that are doing very well and some that are doing poorly, and by picking your spots, you can really add value above the index. So we have seen very clear leadership themes in financials, industrials, healthcare, technology, and the consumer. And if you've been in those spots over the last 12 or 14 months, market's been very, very good. At the same time, you've sort of had to avoid some of the sectors that are more hyper-cyclical. And I think that continues. I think that we are in a market where the themes have some longevity. I think we are no longer in a secular bear market that we went through from 2000 to 2012. And that likely, as we go along, corrections are going to be more shallow and be seen by people as an opportunity to add to their positions. Because most private investors and institutional investors are under-owning equities still, despite the fact market's been pretty good. And there's some pretty clear themes to take advantage of.
Okay, David, we'll take a pause here, and we'll get the questions straight after that on North American large caps. We'll start with an email from Leonard, who's in London, Ontario. It's on Gluskin Chef, GS in Toronto. How high can a Gluskin Chef go? It's had quite a run. What's the story now with this investment bank?
So, Leonard, at Barometer, we have been pretty significant investors in the financials over the last 14 or 16 months. We started in banks. We worked our way into the insurance companies as rates started to rise. And early last year started quite actively investing in the asset managers as our view was equity markets were getting better. Now the leader off the bottom in Canada was CI Financial. They had good net inflows coming before markets got turned around. They had pretty good performance. And so we were buying shares and have owned that for, 14 or 16 months. But along the way, our tendency is when we get a clear theme in place to start adding additional names. And while Gluskin Chef would be a competitor of ours, I think that they are in a good business. We are in a good market. If equity markets continue to be strong, they should benefit. They can earn performance fees. So we're stakeholders. We bought Gluskin Chef on the last issue that was done, I think about $19. And so it's up quite a lot. I think, though, that asset managers in general are going to have a tailwind for some time to come. And not only will they get asset growth through performance, but they're also going to have new money getting put to work as people move from things like fixed income more toward equity markets. So we like the asset managers. We like Gluskin Chef. We like CI Financial. We like some of the asset managers in the U.S.
Right, and I called Gluskin an investment bank, which is not, of course. It's a wealth management company, as David mentioned. Phillips in Edmonton with the next question. Go ahead.
Good evening, gentlemen. A question on Canadian oil sands, please. It looks like their major capital projects are coming to a conclusion sometimes this year. So it means their capital projects finance is coming almost to null by the end of 2014. The company has stagnant share prices for the last 2 years. Does David believe that this is a good time to buy Canadian oil sands for a potential move to the previous high, like in the last 2 years, in 2010, 11.
All right, thank you, Philip.
And thank you.
Thanks.
Okay. So, Philip, thanks for your question. I think that this is a question that affects a lot of different big cap oil companies in Canada. Of course, what's been happening over the last 2-3 years is we've got this enormous boom going on in oil and gas production in the U.S. Based on a lot of new technologies that are being used to add reserves and production. And a lot of that is coming in at very low cost. And so I think that there is a risk to some of the big Western Canadian oil companies that are higher cost producers, that if prices were to stay muted because of all this new production, they are not as profitable. So we prefer to focus on the very low cost producers, and that's more some of the mid-sized companies like Whitecap Energy or Tourmaline than the very large caps. Some of the larger cap names in the U.S., like a Pioneer Energy, which has been growing very quickly, is also attractive. Now, if oil prices can stay firm and the economy really does start to pick up and that supports oil prices at higher levels, then that's to great benefit of companies like Canadian Oil Sands. So it's just a little bit more leveraged play on oil. Our view is that commodity prices are likely to remain somewhat under pressure. So we aren't making a big bet on higher oil prices, so we're staying with the lower cost producers.
There you go, Philip. You got 3 other ideas instead of Canadian Oil Sands. Bo is in Brampton with the next question. Go ahead, Bo.
What does you guys think about buying National Bank as a long-term hold? And what other banks will offer a stock split in the future? Thank you. Bye.
So certainly as a Canadian investor, the Canadian banks represent great businesses. And they give you great exposure as the economy gets a little better. I think, though, if I was given a choice of buying Canadian banks versus U.S. banks, at this point I would be more likely to focus in the U.S. regional banks. I think you do fine, but as we know, the Canadian market has been underperforming U.S. market. I think that could continue for some time. And so we would prefer some of the regional banks in the U.S. or some of the big money center banks like a Bank of America. I think you're likely to see more rapid dividend growth over the next 2 years because they've rebuilt their capital levels. And the revenue growth is beginning. It's very early stages. After being stagnant for some time, some of the large U.S. banks are starting to see some revenue growth. Canadian banks will continue to chug along, but they are a little bit more expensive. They'll have slightly lower dividend growth. You can make money in both. I just prefer to be south of the border.
And give us a regional bank name.
You could look at a Fifth Third Bank Corp. You could look at a Key Corp. You could look at SunTrust in Florida. They all look pretty good.
Okay, STI, SunTrust, and 3 more names there for you. Here's Alex, who's in Thunder Bay. We'll stick with U.S. banks. Go ahead, sir.
I'm just calling about Bank of America. I've held it for quite some time, and I recently just bought some at the new high. But I'm just kind of wondering, in light of this pullback that we're having, is it a mug's game to try and trade in and out of these things? It's my positions are small, and I'm ahead. But what are your thoughts on that?
Alex, I think at this point you want to be careful of over trading. I mean, it's pulled back a couple of dollars off the highs. Actually, less than that, about $1. Bank of America is going to have some tailwinds as you go forward. They had a little bit of revenue growth. Loan losses keep getting better. Bad loans are rolling off. U.S. economy is getting a little bit better. I think that you're going to see them increase the dividend growth over the next 18 to 24 months. And they will do well in the wealth management business. They'll do well in their banking business. So I would not overtrade. I think that we are less likely to be in an environment like we have been over the last number of years where you got really significant corrections. I think we're going to get corrections, but they'll be more muted, and it'll be tougher to trade.
And you hold this one.
And we own this one.
You do.
Yeah.
We will take a break and more with David and your questions after this.